Welcome back. Today is February 13th, 2026. And today we need to talk about something most people still refuse to see. The collapse is not coming. It has already started. Over the last few weeks, markets didn't just pull back. They cracked. The S&P rolled over. The Nasdaq dropped hard. Major tech names, the untouchables, started bleeding. Cisco down double digits. AI darlings suddenly vulnerable. And this isn't random. This isn't profit-taking. This is liquidity being pulled out of the system. And when liquidity disappears, everything falls with it. Let me explain something very clearly. Markets do not crash because of bad news. They crash because funding dries up. And right now, funding is drying up. The AI bubble was built on one assumption. Cheap capital would last forever. That assumption just died. Interest rates are still high. Inflation refuses to collapse back to 2%. Long-term yields are stubborn, and big tech companies are drowning in debt issuance to fund AI data centers. You have over $600 billion in AI capital expenditures planned this year alone. $600 billion. That money isn't falling from the sky. It's being borrowed. Corporate bond issuance from tech firms is at levels 5 times higher than during the dot-com era. Let that sink in. 5 times. The AI boom isn't being funded by cash flow. It's being funded by debt. And here's the problem. If rates stay high, and they will, refinancing that debt becomes a nightmare. There is no guarantee AI monetization catches up fast enough. There is no guarantee customers generate revenue at scale. But interest payments? Those are guaranteed. This is the beginning of the liquidity squeeze. Now let's zoom into the consumer, because here's where it gets dangerous. Delinquencies are rising fast. Credit card defaults climbing. Auto loan stress increasing. Mortgage affordability collapsing. Severe delinquency rates are approaching 2008 territory. That is not a small detail. 70% of US GDP is consumer spending. If consumers are broke, GDP contracts. Period. Home sales just dropped sharply. Why? Because people can't afford the payments. They can barely afford groceries. Tariffs are raising import prices. The dollar weakening makes goods more expensive. Interest rates are crushing borrowing capacity. And yet markets were priced for perfection. They assumed inflation would glide back to 2%. It hasn't. It's stuck. Sticky inflation means sticky rates. Sticky rates mean expensive debt. Expensive debt means liquidity drains. Now here's where this turns systemic. The US government is issuing massive amounts of bonds. Deficits are exploding. Projected spending is rising by over $1 trillion above previous expectations. Revenues are declining. That means more debt issuance. When the Treasury floods the market with bonds, and tech companies flood the market with bonds at the same time, they compete for the same pool of capital. There isn't enough money. That's the liquidity squeeze. And markets are starting to realize it. This isn't 2008. This is something different. In 2008, the system broke suddenly. Today, it's tightening slowly. Slow squeezes are worse because they don't shock you. They suffocate you. Now let's talk about gold. Gold dropped sharply. Silver volatile. Why? Because in liquidity crises, the best performing assets get sold to cover the worst performing positions. When hedge funds need cash, they don't sell garbage first. They sell what's liquid. Gold is liquid. That's not bearish long-term. That's desperation short-term. Now add Japan. The yen carry trade has supported U.S. markets for years. Borrow cheap yen, buy U.S. assets, profit from higher yields. But now Japanese yields are rising. The yen is strengthening. U.S. stocks are falling. If you borrowed in yen and the yen rises 4%, you lose instantly. Add equity losses. Add interest costs. The carry trade becomes toxic. And when leveraged trades unwind, they unwind violently. Hundreds of billions are tied into this structure. If Japanese investors start pulling capital back home, U.S. markets feel it immediately. This isn't theoretical. The dollar has already weakened versus the yen. Hedge funds are reversing short yen bets. The cracks are forming. Now let's talk about the real fear no one wants to admit. Artificial intelligence is not just a boom, it's a gamble. Elon Musk said it himself. Without AI, the U.S. risks bankruptcy. The entire economic narrative now rests on AI delivering a productivity miracle. If AI dramatically boosts productivity fast enough, debt becomes manageable. If it doesn't, the debt spiral accelerates. That's the binary outcome. And markets are finally questioning whether that miracle arrives in time. AI is replacing jobs. If companies automate aggressively, layoffs follow. Layoffs reduce spending. Reduced spending hits corporate earnings. Corporate earnings pressure hits stock prices. Stock declines tighten financial conditions further. It's a loop, and we are inside it. Now look at short interest. Hedge funds are not just reducing exposure, they are actively betting against U.S. equities. Short positioning is at record levels. This isn't retail panic. This is institutional conviction. Volatility is going to become normal. 2 to 5% daily swings will not surprise me anymore. This is not the end of America, but it is the end of easy money. The era of infinite liquidity is over. And when liquidity tightens in the largest financial system on Earth, the consequences ripple globally. Black swans are circling, not because of one event, but because of convergence. Consumer stress, corporate leverage, government deficits, high rates, currency volatility, global capital rotation, all at once. This is not a correction. This is repricing. And repricing phases are brutal. If you are still positioned as if 2021 liquidity conditions exist, you are in danger. This is a different regime, and the market is finally adjusting to it. Let's go further, because what we just covered is the pressure building. Now we need to talk about the endgame. And the endgame is simple. If productivity doesn't outrun debt, the bond market will break the illusion. Right now, everything depends on one assumption. Artificial intelligence will save the economy. That's not exaggeration. That's math. The US debt load is exploding. Deficits are widening toward dangerous territory. Interest payments alone are approaching historic highs. If economic growth doesn't accelerate meaningfully, the debt-to-GDP ratio spirals. And once bond markets lose confidence, yields spike. When yields spike, everything reprices lower. Stocks, real estate, corporate debt, risk assets across the board. That's the real threat. Not a sudden crash tomorrow morning, but a slow loss of confidence. And confidence is already cracking. Let's talk about the global rotation. For 15 years, the United States absorbed global capital. If you were a European pension fund, you bought US tech. If you were an Asian sovereign fund, you bought treasuries. If you were a hedge fund, you borrowed in yen and bought NASDAQ. That structure made US markets unstoppable. But structures change. China is accelerating in manufacturing and AI deployment. Europe is shifting industrial policy. Japan is normalizing rates. Emerging markets are strengthening regional trade. Capital no longer has one destination. It has options. And when capital has options, valuations compress. We are witnessing the early stages of diversification away from U.S. assets. Not a collapse, a reallocation. That is more dangerous because it's quiet. Money leaves gradually, liquidity thins, volatility rises. Now let's go back to Japan. The yen carry trade has hundreds of billions tied into it. Borrow yen at near zero rates, convert to dollars, buy higher yielding U.S. assets. But now, Japanese yields are rising. The yen is strengthening. U.S. equities are unstable. If the yen strengthens 5% and you borrowed in yen, you're down instantly, even before asset losses. If U.S. stocks drop at the same time, you're hit twice. Add interest costs. That becomes a triple hit. When that happens at scale, funds unwind. And unwinding means selling. Selling pressure pushes markets lower. Lower markets trigger more unwinds. That's how systemic squeezes form. Now add the bond market. The Treasury is issuing more debt than ever. Corporate America is issuing more debt than ever. There is a supply tsunami. Who absorbs it? Foreign buyers are cautious. The Fed is not printing aggressively. Domestic banks are constrained. That means yields must stay attractive. High yields are the magnet, but high yields are poison for equities. The higher yields go, the lower stock multiples go. And if deficits continue widening towards 6 to 7% of GDP, bond issuance accelerates further. That locks yields high. High yields lock liquidity tight. Tight liquidity locks volatility high. This is the trap. Now let's confront the uncomfortable part. AI is both the hope and the risk. If AI boosts productivity massively, corporate margins expand, GDP accelerates, debt stabilizes, markets recover on stronger foundations. But if AI displaces workers faster than it creates value, unemployment rises, consumer spending falls, corporate revenues disappoint, debt becomes heavier relative to growth. Which path happens first? Markets don't know. And uncertainty equals volatility. We are entering a regime where volatility is not temporary. It's structural. 2 to 5% daily swings will feel normal because liquidity buffers are thinner. Now think about the political layer. Tariffs remain. Trade tensions remain. Geopolitical risk remains. Energy instability remains. Every geopolitical shock pushes inflation higher. Higher inflation keeps rates elevated. Elevated rates tighten liquidity further. The system is boxed in. Cut rates aggressively? Risk currency instability. Keep rates high? Risk growth slowdown. Increase spending? Widen deficits. Cut spending? Slow GDP. There is no painless lever left. And when policymakers have no painless options, markets feel it. This is why short interest is exploding. Hedge funds are not neutral. They are positioning for downside. That adds fuel to every drop. And when drops accelerate, forced selling follows. Now let's talk about gold again. People expect gold to soar during chaos, but during liquidity squeezes, gold can fall first. Why? Because it's liquid. Funds sell gold to raise cash. But if the squeeze continues, gold eventually becomes a safe haven again. That's the second phase. Right now, we're in the first phase. Cash is king. Liquidity is oxygen, and oxygen is thinning. This is not 2008. There is no single housing bomb. There is distributed stress across consumers, corporations, sovereigns, currency markets, global funding channels. That's more complex and harder to fix. Now here's the final piece: confidence. Markets can tolerate high debt if confidence in growth remains strong. Markets can tolerate volatility if confidence in policy remains stable. But when confidence erodes slowly, multiples compress gradually. That's the grind. And grinding markets exhaust investors. We may not get a single Titanic moment. We may get a prolonged iceberg scrape, slow damage, steady repricing, years of sideways to down volatility, unless productivity arrives fast enough to change the equation. That's the gamble. The entire U.S. macro narrative rests on AI productivity, debt expansion. If that inequality holds, the system stabilizes. If it fails, the bond market forces discipline. And when the bond market forces discipline, it is brutal. The United States still has enormous strengths: deep capital markets, entrepreneurial culture, energy production, military dominance, reserve currency status. But strengths do not eliminate arithmetic. Debt plus high rates plus slowing growth equals pressure. And pressure eventually finds a release valve. We are not at collapse, but we are at inflection. The era of easy liquidity is over. The era of disciplined capital has begun. And in disciplined capital regimes, hype dies first, leverage dies second. Only productivity survives. So here's the question you need to ask yourself. Are you positioned for liquidity abundance or liquidity scarcity? Because 2026 is shaping up to be a year of scarcity. Scarcity of cheap money, scarcity of confidence, scarcity of margin for error. Stay cautious, stay disciplined, and understand this: the real battle is not in the stock market, it's in the bond market, and the bond market does not care about narratives. If you found this breakdown valuable, make sure you're subscribed. We don't chase headlines here, we track structure. And right now, structure is tightening. I'll see you in the next one.